I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
Retail stocks have folded in many cases. Nordstrom down 20%. Other big names as well.
Yeah, actually yesterday there was a little one went by that the trucking in the United States, traffic in September was unusually low. Apparently September can be a good month because that's when they're getting stuff into the stores for Christmas. So I thought, well. And then early this morning I looked at the pre-opening stuff, and the upscale department store group, Nordstrom, their stock was down 20% going into the opening. And a number of hours after the open, it's down 17%. And then there was a brand manufacturer, Fossil. They were down 26% at the open. So this is really quite something. Noticed it about 4 or 5 weeks ago where some reasonably named issues were, like, say, if the Dow was down 1%, those things would be down 5%. So underneath the market, some of the stocks, individual stocks, haven't been doing so well. And also, like within the S&P, you can call it the high in May through the summer was lofty or whatever, but I never ever thought of it as being artificial. When people bid up an index or a stock, it's all fine, it's great fun, it's emotions and all that sort of stuff. But in this case, you knew that virtually all of the 500 stocks in the S&P, that they were buying their stocks back out of the market. And the reason for doing that is, one, they could borrow money very cheaply, and two, their earnings at the top line were not growing that much. So then if they reduce the number of shares outstanding, it makes the earnings per share look better. So there's one artificiality there. And then the other one is more the arithmetic of calculating an index whereby they, on the S&P 500, they have certain weightings to the individual stocks, and that somehow seems to make the index higher than if you look at the S&P in an unweighted basis. So you had enthusiasm and you had a fair amount of artificiality there. So this seems to be coming out, and you could see it falling sympathetically with the crash in the Chinese markets, but everything else got hit as well. Actually, the whole move from the summer was anticipated by the credit spreads widening, the difference between high-grade bonds and low-grade bonds. They did their best in May and June, and then turned around, started to widen, and broke out to new levels in July, following actually similar pattern at the top of the market in 2007, and also the top of the market in 1998. That was going into the LTCM problem. So the credit spreads are really a pretty good leading item here. So anyways, this went down into the panic day, August 24th, which was called Black Monday, and you had a terrific rebound, and then back down and tested it at the end of September when there was a very bad unemployment report. So that was the worst, and then there was a relief rally, and then we used an analog model, which really means to say what these indexes do in similar circumstances in the past, to get the rally on the stock market up until actually last week, when the Dow reached the levels we were looking for, actually exceeded the levels, but that was just enthusiasm. So then the stock markets became vulnerable to correction. The other thing was beyond hitting a target, actually exceeding a target, and the other was that you had pretty good momentum, and then we also got what we call a sequential sell, a number 9, 13 to another one. It depends on how many weeks it takes for the pattern to get established. So you had more or less everything was accomplished, and then the stock markets this week started to come down, and then, as I said, we started to show off with the surprise hits to some of the retail stocks and sectors. So, and we all know that I think 70% of the economy is carried by retail activity. And sure, Nordstrom's is upscale, but nonetheless, it's a hit. And, you know, it's also, the stock had been declining slowly. I'm looking at it now. It had a nice high in July at $75. Rounding it out, and it was just drifting down, and then through October, each of the rallies stayed under the 50-day moving average, and then all of a sudden, bang. And so let's say it was at 64 yesterday, down to 60 and change here. Oh no, $50. Yeah, $50 and a half was the low here today. So that's terrible, you know, if you're long that stock, and there's a lot of institutions would be long that stock, but other than the decay in it, which would be concerning, there was no, like, it didn't get super excited on the way up or did anything silly recently, just all of a sudden off the table. So now what this means is that portfolio managers are going to say, well, what else is going to be vulnerable to a surprise hit like that, and start to try and protect themselves.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. Bob, the world is awash in crude oil. Something like 3 billion barrels now are in storage. Is that a lot?
Oh, yeah. Also, I saw one that in the Gulf of Mexico, in the Galveston, there's a lineup of crude oil carriers, freighters full of crude oil. They've been advised to steam as slowly as possible. That's been on for some time now. And, the game has really changed since 2014, when you had a good rally up into June, and then it's been coming down ever since. And we know that you've got new production came on stream due to new technology with the getting in fracking and getting into the tight structures and that sort of stuff. So actually they've talked a lot about the Saudis competing and wanting to drive out U.S. production from shales. No, that's the story afterwards. What it was is that you're one in a post-bubble contraction when commodities are weak. The other one is that you had the lead from natural gas declining from that big trading range it had for many years down into a low regime of a trading range. So I don't think it had anything to do with the Saudis, and this was invented afterwards. So anyways, we have low crude oil prices. Now, going back to 2014, once the top was in, we were then looking for, and for historical reasons we used crude oil in gold terms, and in the 1930s, crude oil fell to between 1/3 of the high in gold terms and 1/4, so we just use that as a guess. So the way that turns into dollars per barrel was first target was 37, which we've hit, and then on further time, if it does a full quarter a fall to 1/4 of the high, That would be at 27. So, yeah, I think it can go down to 27. It might inconvenience a lot of people, but nonetheless, this is the problem. In a post-bubble contraction, the senior currency becomes chronically weak for most of the time against most currencies, and most commodities are here. So also the weak crude oil will inconvenience ambitious governments like Russia's. They can go broke again like they did in the 1990s. So this is just, it'll go on forever. You've had, like, this week, a new low for copper. The bear market started in 2011. You also had a new low for nickel and zinc, and a new low for the index, GKX. In the last few weeks, you've had some recovery in the grains, and they now, as of this week, are starting to weaken. So it's just very tough for producers. You've had oil patch stocks weak, you've had base metal miner stock weak, and then of course you've had weakness in the precious metal sector. A couple of weeks ago, our technical work noticed that the commitment of traders figures that came out, and they of course tell you what the commercial traders are doing, what speculators are doing, and all that sort of stuff, and they were moving quickly and getting very negative. So we then came out with the sell on both gold, and actually the commitment traders figures for silver were even worse for gold. So they have sold off quite strongly, and they got stabilized somewhere in here, but you have this problem that, and particularly in the precious metals business, where for 50 years, going back to the 60s, you had the gold bugs in play, and they knew that the Fed's methods and depreciation are evil, and it was sort of like, let's get even with those, you know what I mean, and get long gold and long silver, and that played right up until 2011. Now in 2011, we watched in any bull market for gold and silver will outperform gold, and when it gets highly speculative, the outperformance is terrific, and it shows up on a momentum measure, the RSI. So the daily RSI in spring of 2011 got up to 92, and through previous historical work, we knew that the big bull market to January 1980 was the only other time it got up to 92. So then that said, we pointed out that it was dangerous, and then the next big rally was up to September 2012, when then the RSI got up to 84. And the last time we used that model to lighten up or get out of the sector was last May. And we, beginning a couple of months ago, started looking for a base in the sector, and we needed to have the gold stocks outperforming the bullion price, and we had that basing and a little rally out of it. Got a bit of a rally out of the sector, but I never did recommend accumulating gold stocks because there were just too many problems. And then, as I said a couple of weeks ago, we got the numbers from the COT, and they were negative, and so this is a hard hit, and it'll still take a long time for this to stabilize, because you're changing from the gold bug theory that was prevalent for 50 years, that you bought it because the Fed was going to depreciate, and but now it's going into a regime whereby the gold shares, when they advance, they'll be advancing on improving earnings, and the improving earnings will likely come from the costs of gold mining being depressed, like wages and energy prices and blasting and all that sort of stuff, which is happening, and so having those prices down relative to the bullion price, and the bullion price relative to commodities is improving, so that's a positive. But in the meantime, you get problems in the big stock market, and you're not going to be able to drive gold stocks up no matter what when you've got the big stock market under some pressure. So again, it's just time to continue to stay aside from the precious metal sector.
We keep hearing reports that the price of oil is going to stay depressed for quite some time, maybe 4 or 5 years.
Yeah, it could do that. The Perhaps the U.S. economy is in a recession, and it'll take some time before the official National Bureau of Economic Research, the NBER, determines that it's in a recession. But if you look at certain indicators, it could be already. In which case, it may be 2 years of a recession, and you're not going to have crude oil going up much. And if U.S. is in recession, let's face it, the rest of the world will be in a recession as well. And I don't know how you describe recessions in China. That's pretty. Maybe their growth rate goes down to 2 or 3%. I don't know, but there's a whole lot of weird stuff going on there. So yeah, crude oil all commodities could be weak for at least another year or so. You're going to have some rallies. You got seasonal forces going on. There could be another disaster story out of the Middle East, but that would affect crude. But then the whole global marketing and production and sales of crude have changed dramatically, lessening the influence of the Middle East. So let's just wrap it up with one of the features of a post-bubble contraction is the senior currency, which is still the U.S. dollar, becoming chronically firm against most of the commodities and most currencies for most of the time. You did have the U.S. dollar index rally up to 99 last week, or on Monday, I guess it was, and it'll correct here for a bit. That was quite a rush. Might trade around 98 for a week or so, and then the next phase will be up. And it's going to be fascinating to watch this because it is contrary to all of the economic theories about the Fed being able to depreciate the dollar at will. So, hey, maybe it gets bad enough that people condemn the Fed and the policymakers for such reckless behavior.
Bob, thanks a lot for chatting with us.
Good to be with you.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Check out our popular YouTube channel, Talk Digital Network. You can forward questions or comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.